Hi, everyone. This is Jason Bierko of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is the former Wall Street bond trader at a number of different Wall Street firms. He's a gold fund manager, and he also writes two different investment newsletters at Investment Research Dynamics, the Mining Stock Journal and the Short Sellers Journal. Dave Kranzler, thank you for joining me again.
Jason, thanks for having me on again. It's always a pleasure.
So, Dave, we're recording this interview on Monday, April 10th, 2023. Lots of crazy things happening the last couple months since we had you back on. Obviously, we've had Credit Suisse, UBS, the two smaller banks here in the United States, although in terms of actual size of failure ones, they're pretty large, but relative to like JP Morgan and the other too big to fail banks, they're still pretty small. I want to get your thoughts, though, on the derivatives, because we were discussing this. I always get these questions asked all the time. What are interest rate swaps?
What are interest rates? I mean, you can make them as simple or as complicated as you want. I mean, if you trade them and price them up and try to hedge them out, et cetera, if you're a speculator, there's some complicated math involved, but it's basically just a derivative contract in which two counterparties agree to exchange interest rate payments on a notional amount of debt, where one side is paying a fixed rate of interest on their debt, and they prefer to swap into floating rate for whatever reason, and the other side is paying a floating rate interest rate on their debt, and they want to remove that interest rate risk and swap into a fixed payment, and it's over a set term. So, for instance, the guy that has the floating rate debt and doesn't want to speculate on interest rate risk, the obvious user would be like a company that's took down project finance that has a floating rate on it, and they're using that money to build an asset. For instance, a mining company building a mine, and they don't have cash flow coming from that mine yet until it's done. Just help service the debt. So they don't want to take interest rate risk on the floating rate debt that they took down. So they'll find someone who wants to swap with them. And on the notional amount of debt, they then swap into a fixed rate of interest. And it's obviously going to be higher rate of interest than the floating rate that they're paying, but it removes the interest rate risk from their equation. And the other side, for whatever reason, wants to speculate on interest rates, or they may have an asset liability situation where it makes sense for them to make floating rate payments on the notional amount of debt on their balance sheet rather than fixed.
So if I'm going to summarize this even easier for our listeners to digest this and understand, that means that one side is betting that interest rates will go down more. So during the 15 years or so that the Federal Reserve Bank and other central banks were artificially suppressing interest rates with zero interest rate policy, with financial repression. So these, the European Central Bank, the Federal Reserve Bank, the Bank of Japan, were buying all this government debt, corporate debt. They were buying mortgage-backed securities, trying to suppress rates. So if you were a large bank, say a JP Morgan or one of these other guys that owns an enormous amount of interest rate swaps, you would buy these interest rate swaps and you would take the variable rate risk, knowing that the Federal Reserve Bank and other central banks were going to keep our interest rates artificially suppressed and low. And so then you would get paid by the counterparty then on these derivatives extra sums while interest rates were being manipulated down.
That's one really good example of why a bank would want to swap a fixed rate for a floating rate debt payment is speculative purposes. So I think these banks, and part of the problem with an interest rate swap, the thing about these interest rate swaps is everyone says, oh, well, when you look at the total amount of derivatives outstanding, oh, well, most of that's interest rate swaps, plain vanilla. And it's like, no, there's no such thing as a plain vanilla derivative contract. Right? I mean, just by the nature of what it is, a derivative contract has all kinds of sources of risk, not the least of which is counterparty risk. And I think the hedge funds actually are big speculators on the floating rate side of an interest rate derivative contract.
But the banks own most of these things. So the banks are the majority counterparty. Maybe there's insurance companies and pension funds. I think the UK pension fund was involved in this too over the summer in 2022. I think they were also betting on interest rate derivatives as well. And that was part of the problem. But what came out, Dave, and you and me have seen this, but others are not talking about this, is in the Credit Suisse bailout, where UBS took them over, they actually got in writing loss guarantees on interest rate swap derivatives from the Swiss government and Swiss National Bank. But those entities are not big enough to handle the losses of these interest rate swaps if the losses are, say, hundreds of billions or trillions.
Yeah, I think what that was UBS basically got a blanket $100 billion loss guarantee from the Swiss government, and that included interest rate swaps, which is probably a big part of what they're worried about. But there's also lots of other, garbage, liquid duty derivatives contracts, credit default swaps, et cetera, on Credit Suisse's balance sheet. So, but certainly interest rate swaps probably the largest component on a.
And I'm guessing
basis.
You weren't surprised that within about a week, we started seeing problems at Deutsche Bank, because I know that you were working at Bankers Trust for a while, and you were telling me years ago that Bankers Trust had this absolutely horrible derivatives book. And then Deutsche Bank, 20 years ago, bought that derivatives book from Bankers Trust.
Right. But you know what? When you refer to it as a horrible derivatives book, it means that while it was being put together, it was obscenely profitable. And that's why these banks, that's why the derivatives market got so big, and it's why it's largely unregulated, is because it's so wildly profitable for these big banks to underwrite derivatives of all flavors, not just interest rate swaps.
Oh, I agree. They make profits until they don't. But since post 2008,
it seems like to bail them out.
Exactly, Dave. I actually went back and I looked up the size of the derivatives market back in 1998, before Alan Greenspan and Robert Rubin and Larry Summers got rid of Brooks Lee Bourne at the CFTC. And the derivatives market back then was around 29 trillion. And here we are, a little over 20 years later, and we're over 20x that size.
Yeah. Yeah. And, people will point to, oh, well, you got to, they changed the accounting rules and the regulatory rules so that after 2008, the banks could just book their net exposure after you net out counterparty risk on the, and they still account for most of these derivatives off balance sheet anyway. But if you go into the footnotes and you look at their level 3 assets, which are these derivatives, they net, or they may have a separate disclosure for derivatives, and then it shows the net exposure, but really what their exposure is, because of counterparty risk, is the gross exposure, the notional amount.
I was actually going through the JP Morgan annual report a few years ago, and they actually didn't mention any of the amount of size of the derivatives or any of the hedging. I mean, a lot of it was just basically talking about how profitable the derivatives are, and there was only small summaries of it. There was very little information in their basic annual report, even in the footnotes, about their derivatives book.
And that's by design. I mean, that's, you referenced the Rubin Greenspan thing. Larry Summers was involved with that. As well, in terms of there was a push to really regulate these derivatives, and led by Brooks Lee Bourne, and the powers that be pushed back against that, and they never were regulated the way they should be, and that's why we had what happened in 2008. And that's why we have what's happening now. Only what's happening now really started in 2019.
Exactly. Every Fed rate hiking cycle now, Dave, it seems like the derivatives, one of the major derivatives just blows up, and then the Fed lies about the size of the bailouts. We wouldn't even know about the size of the bailouts if it wasn't for the people at Wall Street on parade going through the New York Fed disclosures, thanks to Dodd-Frank, about the 2019 repo crisis and in 2020. Yep.
That's exactly right.
So you think then until the derivatives are eliminated, and I don't really see that happening, there's basically going to be guaranteed failures every 2 to 5 years now because of the sheer size of the derivatives. I know the talking heads on TV. So if you see a banking expert on TV, and anyone asks about derivatives on CNBC or Bloomberg, the industry line, whether you're a lawyer here in DC and you're part of the Derivatives Trade Association, or you're a lobbyist for the Derivatives Association, and they have a lot of backing too. They have their own separate team of lobbyists here in DC, very expensive lawyers too. And their narrative is always, well, these things are netted out, and you always worry. But in hindsight, Dave, every 2 to 5 years, it's like clockwork. These derivatives blow up now.
Well, I mean, they're really, on paper at face value, they're netted out because, you're a bank and you're laying off a good part of your derivatives book, the risk of it, to speculators, hedge funds, or other counterparties who, might want to take on that risk in exchange for getting paid to take on that risk. And
I think the insurance companies and the pension funds got involved, and I think that's a problem.
And pension funds. And as soon as your counterparty, once the counterparties start to topple, that's when the whole thing comes down. It's a house of cards. And that, that's what we saw in 2008, and that's what we're starting to see now.
Yeah, I actually had a conversation for many, many hours with Rob Kirby. I didn't record it because a lot of it was so complicated. It actually took me a long time to think about it later. And he was just talking about how in the past, and for our listeners who are not familiar, Rob actually used to trade these things professionally when they first started in Canada. He was an investment banker working on derivatives in, I think, the 1980s, 70s and 80s. I think he said they started in Canada. And then the US banks saw how profitable they were, and they started just creating them. Same thing for European banks. Over the decades too. And he said in 2008, he saw approval rates. He said normally in the past that you would have to go to your risk manager if you're a derivatives trader or you want to create or buy derivatives, a large amount of them, even a couple of $1 billion, he said. And it would take, with the risk management at your bank, it would take weeks, if not months, to get approval for a large purchase. He said in 2008, he said it was bing, 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 bing. Every 5 minutes that tens of billions of dollars worth of derivatives were being bought. He said he had never seen anything like this in his life. That he said it had to be a government-backed entity, Exchange Stabilization Fund or the Federal Reserve Bank or US Treasury. Some type of slush fund was billing out derivatives back then.
It could be. And just for the record, I'm not anti-derivatives. I mean, there's bona fide valid uses for derivatives. I mean, your simple calls and puts on stocks. Those are derivatives. Yeah. And they're useful for hedging. They're useful, speculators, who think that there's more intellectual ability in analyzing these things than just sheer gambling. They're interested in it out of greed. The problem is that the lack of regulation, but a big part of that lack of regulation means that all of these derivative contracts are mispriced, and they're mispriced because they don't price in the realistic degree of risk, of counterparty risk that's involved in these derivatives. So, if you're trying to hedge out interest rate risk with an interest rate swap, you're paying less than you should because pricing the counterparty risk has been kind of removed. It's been removed from the process. So, if derivatives transacted at the proper price to that reflected all of the risks involved with them, I have no problem with them.
Oh yeah, I agree. So,
and
yeah,
that's, and this goes back to, long-term capital in 1998, 1997. I mean, it claimed its book was perfectly well hedged and that it was generating alpha on a lot of alpha on a hedge book. Well, as it turns out, it wasn't properly hedged, was it?
Well, I think if the derivatives market is going to be efficient, it should have been a lot smaller. The size it is now, it has to be a fraction of the size. It cannot be around a quadrillion. So these interest rate swaps.
Well, it would be, and it would be naturally if the proper regulations and the proper boundaries were put in place so that they were priced properly to reflect all the risks involved. It's not just counterparty risk, it's liquidity risk.
So for listeners who are not familiar, the only one who's actually tracking the size of the derivatives market is the Bank of International Settlements. So twice a year, so biannual report, they release a over-the-counter derivatives report, and the largest amount in there is the interest rate swap. So interest rate sensitive derivatives, I think it was over 300 trillion in size. So I don't know if that's exact. It could be off by 100 trillion here, 200 trillion there. I don't know. But that's the one that tracks, that's the entity that tracks the derivatives market the most. I think there's one other dealer in Chicago that tracks it, but they use a lot of the Bank of International Settlements data.
Right. And I mean, what's insane about that is I'm pretty sure there's not 100 trillion or $300 trillion worth of actual underlying debt that's been issued globally at the public and private level. You see what I'm saying?
Well, who
You've
has the
got
cash flow to pay off those bets when they go bad or a counterparty fail?
well, you've got a notional amount of interest rate swaps that's multiples of the actual amount of debt that's outstanding. So, I mean, it just tells you that there's a lot of speculation going on in these things. And when you have speculation, it means, a lot of shadow bank pools of capital. And that's one of your biggest sources of counterparty default risk.
This makes no sense, Dave, because this, for our listeners out there, the analogy, this is a casino where the people, the hedge funds, the pension funds, the insurance companies, the Wall Street investment banks are allowed to make these incredibly leveraged bets, but they don't have the cash to pay it off if they lose the bet or their counterparty fails.
Right. Or they took, shaky collateral against the amount of leverage that they extended.
Yeah, so this is for listeners, to sum it up. I mean, this is part of the problem. And this is also what's worrying me. We're going to talk about the major bubble that we're seeing now with US regional banks, commercial real estate, but we don't have an exact number of the commercial real estate mortgage-backed securities. So yeah, if the banks have bad loans, commercial real estate, I mean, eventually the market would find a bottom. People would buy the commercial real estate at pennies on the dollar. The problem is all these extra derivatives that were attached to this, similar to the last bust, a real estate bust here in the United States, which was residential. You had all these trillions of derivatives, mortgage-backed securities that were attached to it, and the Fed had to buy 3 trillion in mortgage-backed securities.
I think it was between 2.5 and 3.
But if commercial real estate does fully collapse, and we're starting to see the sales of these properties in all these major cities and metro areas, and these commercial real estate properties are literally selling for pennies on the dollar, 50, 60, 70% discounts, the commercial real estate mortgage-backed securities, those things are going to be blowing up then too soon, right?
I think, yeah. I mean, it may have already started. We're just not seeing signs of it yet. Well, actually, I take that back. We are. I mean, look at Blackstone. Blackstone had to gate their fund, their real estate funds, because their underlying assets were blowing up, and investors were trying to take their money out. And the market for these assets is relatively illiquid. So it's not like, Blackstone can go and sell a commercial mortgage-backed security or a commercial building itself, right away, in order to honor investors who want, in order to honor redemption. So they gate the fund. They leave the money trapped in there until they can, figure out a way to raise the capital and I don't think they'll be able to. I think a lot of these investors are screwed.
Yeah, I think we saw also Starwood, another commercial real estate fund
that's another good example.
So these are all red flags that have occurred in the last 4 to 6 months, where these closed-end funds, these commercial real estate funds, are starting to shut investors from selling out. We're seeing real estate investment trusts start to slash their dividends when they said only a couple months ago they wouldn't do it. So these are all red flags that are just flashing that in the next, I don't know if it's 3 months, 6 months, 9 months, 12 months, but the commercial real estate bust, the bubble is about to bust here in the United States.
Yeah, and I mean, I think you could probably argue that it already has to some degree busted. I mean, the poster child right now, the poster child REIT is Vornado, right? I mean, it was back in 2018, it was at 75, and now it's at 15. And it actually did a cliff dive, during the market crash that preceded the pandemic lockdown. And it bounced a little bit, but it never got even close to where it was trading, which was at 65 back in mid February of 2020. And now now it is where it is. 50. I mean, it's just, to me, that is emblematic of the deterioration that's going on in the commercial real estate market.
So do you think the Fed's actually going to allow these bankruptcies, or is the Fed just going to create new liquidity programs, new bailout programs? They have a domestic repo facility, a permanent one that hasn't really been used yet. Do you think the Fed's just going to come up with new ways to plug the hole and paper over this crisis?
I don't know. Well, I mean, that BT, what was it, BTFD?
Is that the one where they're paying regional banks, what, a 20 or 30% subsidy to buy some of these bonds?
Well, they're lending the regional banks, so they've got, mortgage-backed securities marked at 85 cents on the dollar. They put that up as collateral, and the Fed lends them par value, 100% of what the face value of the loan is. So, I mean, that's
a subsidy,
no one's
right?
calling it. No one's calling it. And the mainstream media is calling it QE, but that's what it is. I mean, it's money printing essentially.
Well, it sounds like a subsidy or bailout because the assets are not.
It's a bailout, is what it is, and it's small scale right now. I think this is going to get much worse, and it's the $64,000 question as to what degree will the Fed actually, really crank up its printing press again in order to keep the system from collapsing, the financial system, because I think that's where we're headed if the Fed doesn't print a boatload of more money at some point.
In 2019, the Fed actually played similar games. So they loaned out at full par value a lot of this stuff during the repo crisis. Jerome Powell said, if you go back and look at his speeches in October 2019, he said it wasn't QE. We're going to loan at full par value, but the assets were not worth anything close to par. And what the games that the Fed played, they just kept extending the loans. So the loans were, I think, like daily repo, and then it got extended to weekly, and then it got 2 weeks, 3 weeks. And within about, I think, 3 months, Dave, from August 2019 to October, November 2019, the Fed's official balance sheet had increased by $1 trillion. And people had forgotten about it pretty soon after that.
I didn't forget about it. I actually wrote a in-depth analysis of it in October of 2019. I said it's, essentially the financial system has a giant margin call that's in process, and these repos are designed to put up more collateral, so to speak, against that margin call.
Oh, I know. I did tons of Repo Madness videos back in 2019. I just say most of the people. So the CNBCs of the world. I mean, CNBC during Archegos and Credit Suisse over 12 months ago, they spoke about it for a week. I was being told by hedge fund managers that Credit Suisse was a ticking time bomb over 12 months ago, that they were in big, big trouble.
Yeah, if you're paying attention and you know where to look for information, as you do, the warning signs for Credit Suisse were out there for a couple years at least.
So for commercial real estate, did you see the tweet from the New York Fed director, this guy, Scott Reckler? He's also a real estate investor. I guess he decided to be honest out there. So he put his analysis of the commercial real estate market on the record on his Twitter on March 22nd. So he said there's 1.5 trillion in commercial real estate debt maturing in the next 3 years. The bulk of this debt was financed when base interest rates were near zero. Debt needs to be refinanced in an environment where rates are higher, values are lower, and a market with less liquidity. He's not even talking about how like a lot of the tenants don't want to pay the rent or can't afford higher rents, and the occupancy rates are collapsing.
I think you might have showed me the tweet, and that's what the big problem. Well, it's I think what could bring down the house, so to speak, in the commercial real estate sector is the fact that all these, there's a lot of commercial real estate debt that needs to be refinanced, because certainly the borrowers of this debt don't have the capital that it would take to just mature them, right? So they got to refinance them. And as you point out, or as this guy pointed out, most of that debt was issued when interest rates were near zero. And now, in order to refinance them, unless the Fed starts to quickly reduce interest rates, right, they're going to have to refinance them at much higher rates. So that's gonna bring down the house at at a lot of commercial real estate entities and REITs.
And then also the knock-on effects then are these regional banks, the U.S. regional banks, and some of these regional banks. I had on Ted Oakley, who is owner of one of these. He owns a large equity interest in one of these regional banks in Texas. And he was talking about how the loan books for some of these regional banks are 60 to 70% commercial real estate. So that's a ticking time bomb, I think, too.
Absolutely. Absolutely. This has the potential to be, in the commercial real estate mortgage outstanding, I think is off the top of my head about 4.5 trillion or something. I mean, it's smallish compared to the amount of consumer debt or the amount of corporate debt or even non-investment grade corporate debt. I throw triple B paper in there in non-investment grade because when I was trading junk bonds, what's called triple B now would have been a junk bond back then. But yeah, I mean, and it's just to circle back to what you pointed out at the beginning, a lot of this debt also has derivative trades, OTC derivatives wrapped around it or attached to it. So, not only do you have the notional amount of commercial real estate debt at risk, you've magnified the degree of that risk by the degree to which they've been levered up with derivatives.
Yeah, I think the regional banks already have around 600 billion in losses that the regional banks there's experts out there claiming that they can hold some of it to maturity. But I mean, if the banks need to raise capital, Dave, they're not like JP Morgan or the Federal Reserve Bank of the US government, where they can get away with legalized accounting fraud, or they can do cash-based accrual accounting or mark to model. So if you're a regional bank and you want to go raise capital, you have to mark to market your losses on those securities and your loan book. And then all of a sudden people start to see what happened with Silicon Valley Bank and some of the other regional banks. And so I don't think this banking crisis, I think it's just started. We're in the first or second inning then of this regional banking crisis.
Oh, no question about it. No question about it. And you're not, Silicon Valley Bank was referred to as a regional bank, but I think it was in the top 20 in terms of its asset size, top 20 of all U.S. banks. So, it's not your smallish little regional bank that, you might, if it's a local bank, like I have my checking account at a local bank here. And I'm sure if I looked at their loan portfolio, I'd be horrified. But that's what we've got. And so I think anyone who keeps more than the FDIC insured amount in any bank, but especially these regional banks or local banks, I think you're insane.
Yeah, we were discussing this before we started recording. We were talking about all the hidden risks at these credit unions, these smaller regional banks, that if they need emergency capital from the Fed, either it's at penalty rates or they might not get it at all, because the Fed's job is to make sure they're too big to fail banks, which are their owners of the owners of the Fed, and vote people onto the Fed and control the Fed, that those guys are getting the ballots, that those guys are getting the cheap capital. I just see the larger banks doing asset stripping. They're already hiring the best employees from these small regional banks, because I'm reading these articles that the best employees at the smaller and regional banks already see that the red flags and that the bankruptcies at the regional banks are coming. So they're already leaving for the larger banks.
Right. That makes sense.
But I have this chart in front of me for top 20 banks by commercial real estate portfolios. So it's Bank of America, JP Morgan, Wells Fargo, Citigroup, US Bancorp, Capital One, PNC, TD Group, SunTrust, Morgan Stanley, BB&T, Goldman Sachs. So Silicon Valley Bank is not even in the top 20, and they still had a lot of problems. So it looks like almost all these banks, all the big banks that people are familiar with, are going to have some serious problems, or at least loan write-downs, big ones in commercial real estate.
Right. And well, SVB, their thing wasn't commercial real estate per se. They just had a huge portfolio of long maturity mortgage-backed securities, government guaranteed, agency guaranteed mortgage-backed securities, and just treasury trusts, things like that. They needed to invest at a longer duration in order to get earn an interest rate spread over what they were paying on deposits. So, from just off the top of my head, I think SVB's securities investment portfolio was about 120 billion, and that was, I think that was after they sold the available for sale securities that basically triggered everything. And then they have a $73 billion loan book that was it just had garbage in it. I think I might have posted, I wrote about it in my short sellers journal, and I think I might have posted that on my blog. If people are curious, because I show the the copies of the pages from the latest 10K, what kind of garbage was in there.
So you are most worried about the real estate investment trust now more than, say, some of these larger banks with commercial real estate exposure?
Well, like you point out, as a percentage of assets, commercial real estate isn't a big exposure for the too big to fail banks, but they're going to get bailed out anyway, right? It doesn't matter. So
I think they'll get even larger. I think the Fed's gonna subsidize so they can go in there and pick and choose and asset strip the best stuff from the smaller banks.
And it's what they did in 2008, right? With Bear and Merrill Lynch and Countrywide. The Fed took on the bad assets, and they've essentially handed the good assets to the likes of JP Morgan and Bank of America. So with backstop guarantees if some of the assets went bad. But I'm worried about everything related to commercial real estate, particularly the regional banks and the local banks and the credit unions. But I think we've got bigger problems than commercial real estate, and maybe commercial real estate will be what triggers it. I don't know.
So the bigger problems, what do you think they are? Are they derivatives or something even larger than that?
I just think it's a general too much debt problem. Everything debt, mortgage debt, consumer debt like credit cards, autos. I mean, these credit card debt and auto debt. See, part of the problem with that is a lot of this debt that's held as assets on bank balance sheets that gets rehypothecated and put up as collateral in other parts of the financial system. So, and it doesn't take a high default rate on credit cards or on mortgages to topple the system. I mean, the default and foreclosure rate on I think mortgages, it was under 10% in 2008, 2009. But look what happened. And part of that's because of all the derivatives, and also just the leverage that's involved, right? I mean,
Yes.
if you go out and you buy a house and you put down 10% equity, and it's an investment house, it goes up a little bit in value. You say, oh, I'm gonna borrow against my equity in this house and go buy another house. And then you string together a portfolio of 10 houses, and that's great while home values are rising. But when home values decline, and all of a sudden you have trouble making, and rent goes down, and now all of a sudden you're bleeding cash instead of earning cash on your properties, you default, and those houses are worth a lot less than the amount of debt that you've taken out to buy them, and then multiply that over thousands of small time real estate operators, and that's how it happens.
What we're also seeing now, Dave, over the last 4 to 6 weeks, we're seeing the retail investor pull their cash out of the bank accounts at these regional banks, credit unions, and they're putting it like crazy into U.S. Treasuries, into money market funds. I'm seeing these YouTube videos that have hundreds of thousands of views saying how to make a risk-free 4.7% return in either U.S. Treasuries or money market funds. I guess people forget that these money market funds also gamble, and they were loaning into repo in 2019, and that the U.S. Treasury collateral and other stuff that the money market funds hold, it could also be hypothecated or rehypothecated, and that the money market funds had to be bailed out in 2008 and 2009, and then again in 2019 during the Repo Madness crisis.
That's right. And I would not recommend anyone put their money in money market funds, because it's just so easy. You have an online brokerage account. It's so easy just to go and buy a 3-month T-bill, and then you don't have the embedded risks in money market funds. I have a buddy a good friend who worked for a pension consulting firm at one point, And one of the things that they would do is they would tear apart the prospectuses for money market funds. And I remember he told me he tore apart the prospectus for a series of PIMCO money market funds, and he said you'd be amazed at the degree to which they've got hidden derivatives in those things. And so I wouldn't go near a money market fund. But look, I'm one of those ones who move money out of a bank account into T-bills. I take care of my mom's money, and I've had her sitting in cash, at the brokerage custodian, earning what, 0.5%, 1% a year. And I don't even know why it took me so long for it to occur to me, but a couple months ago, I'm like, wait a minute, I'm just going to go and put all this money in a 6-month T-bill, and all of a sudden, she's earning 5% on that money instead of 0.5% or 1%.
Well, the problem is that even though people see that nominal return, I mean, it's still below the CPI, the official government inflation rate, and then the government's going to tax.
No question about
and then
that.
The government's going to tax it too. So any of your gains, the government's going to. So unfortunately, that's a problem. So I mean, like, if people want to beat the CPI number, they probably have to look at oil pipeline stocks or stuff that has a little bit higher yield. I think in general, a lot of these oil pipeline companies have pretty safer yields. I think I'd rather own those as an income product, an oil pipeline, because oil and natural gas in a major area than some of these money market funds.
Boy, I don't know, because then you're still taking a lot of risk on those things. And it's not just price risk on those things. But anyway, I mean, for her purposes, a 6-month T-bill, and I'm actually worried about the debt ceiling crisis, because the T-bill series that I bought for her matures right around when this debt ceiling limit situation is supposed to come to a head in October or September. So there's even risk with those, because who knows what's going to happen. I'm sure they're going to political grandstand and extract a pound of flesh out of each side of the aisle in Congress, but they'll come to some sort of agreement and raise the debt ceiling. So
there will have to be trades made for votes. There'll have to be stuff snuck into bills.
Exactly. So I'm very comfortable, even though I know on a real return basis it's still negative with inflation. It's better than it was when it was earning 0.5%.
So do you think this is why non-G7 central banks are enormous buyers of net tonnage of physical gold, and Chinese private sector demand of physical gold really over the last 6 to 8 months has started to explode?
Yeah, that's a good point, because I think it's just a general distrust of the Western financial system and the Western central banks. The obvious devaluation of Western fiat currencies from all the money printing that's been going on, especially the Fed. Fed's been the most prolific money printer of any central bank since 2008. I also think, I think the sanctions on Russia and the U.S. confiscating Russian assets held in Western central banks, that was also that basically blew up any residual trust the rest of the world had for the Western banking and financial and governmental systems. But I think with respect to the central banks, the Eastern Hemisphere central banks, like the BRIC bank central banks, the SCO central banks, et cetera, I honestly think that part of the reason they're accumulating gold so quickly and in such large quantities is I think they're setting up a transition to a new global monetary system. And they're going to remonetize gold. In other words, they'll create some type of currency, and I have no idea what it'll look like. I don't think anyone does, at least from the outside, that will be anchored to the price of gold, or anchored not just to the price, but anchored to gold, right? Real gold sitting in central bank vaults, like the way it used to be.
Well, if you're a foreign government and you're outside the G7 and you're running a trade surplus and you're seeing that you can get 4.5% or higher on a US Treasury, but that's still below the CPI rate. So it just makes more sense to diversify your reserves into gold then, because you're getting a return below the official government inflation rate. So basically then the US is inflating away the value of your Treasury holdings if you buy it.
That's right. But there's another component to that. If you're a non G7 bank and you buy treasuries from the Fed, you're keeping those. The Fed is the custodian of those treasuries, and so that separates you from that capital or that asset. And if for some reason, like we saw with the U.S. and Russia, you piss off the United States government for some reason, they're gonna say, you know what, you don't have access to your Fed custodial account. It's ours now.
Yeah, I mean, Japan is buying Russian oil now. So they said it for a while they weren't going to buy it, but then they decided since it's heavily discounted, they're going to buy it now. I mean, the U.S. government at some point could decide we're going to put sanctions on Japan for buying Russian oil because you're going against our foreign policy directive. So there's risk there to owning a lot of treasuries. Although Japan recently, right, has been selling a lot of treasuries.
But yeah, all of the both big holders, China and Japan, have been whittling down their treasury holdings.
And China has just been the People's Bank of China, their central bank, the last 4 or 5 months. They've been just issuing press releases, enormous tonnage purchases of physical gold. They haven't released these press releases announcing gold purchases like this in many, many years.
Yeah, that's true, and we're also not seeing what their true holdings are. That's what I would love to see. But I mean, I'm sure you've read.
We'll never see the real numbers.
I'm sure you've read Alistair McLeod's research on it, and I think
he said there's what 30,000. He says 30,000 tons or something.
I think his number is like somewhere between 25,000 and 35,000 tons, and I think he's in the ballpark.
Well, I can tell you because I have sources in mainland China, and I see people posting out of Hong Kong on Twitter. I have contacts there too. That just private sector Chinese demand, because the private sector investor in China does not have a lot of investment options. They're upside down on their mortgages and their investment properties in China because they're having a big real estate bubble, and the Chinese government's printing to save their large too big to fail banks, which are state-owned enterprises. So basically, the investment options for someone in mainland China, a lot of people are just hedging with gold now. The purchases of physical gold for private sector in China are enormous.
Yeah, and you can just walk into a bank and buy gold.
Well, they're buying it as jewelry too. So they're not buying like the 14, they're not buying the diluted 14 karat gold jewelry that you see here in the United States or the Western world. I mean, they're getting a really, was it 24 karat or close to 24 karat. So they're getting,
that's correct. And then they also love the kilo bars of gold. Or you can buy even smaller bar denominations.
Oh, those gold pandas are nice, but the premiums on silver pandas and gold pandas are really high for Westerners.
It is, but you know what? It's not as high as it was in like 2008, 2009. The pandas had the highest premiums, especially the gold pandas. And then I guess China started releasing a lot more of the pandas to the rest of the world, and it drove down the premium a bit. But you're right, it is that like the premium on the silver pandas is the same as the American silver eagle.
Yeah, I bought some silver pandas as gifts for family members. They really like them. They're a very popular coin.
Oh, I love the silver. You should, if you get a chance, you should try and buy some colorized silver pandas. Those are really cool.
Oh, I haven't seen those. I know the Perth Mint has some colorized ones, but that was like their Deadly and Dangerous series, and those are numismatic ones.
Oh, okay.
Have you seen those? Like, there's like a great white shark that's painted, a numismatic one, and it's worth like, I think 50 times the melt value of the coin. It's worth a lot.
Oh, wow. Yeah, I bought some colorized pandas. JM Bullion had them, and I wish I should have bought more, but and they were probably about a $20 premium to just a standard silver panda, maybe a $15 premium. But as soon as they disappear, they go up in value. Like I think I paid 52 a coin for these. This was, I forget exactly when, but it was last year. And I bet you I could lay them off on eBay at $100 a coin, but I'm not. I'm just going to hold them.
So as we wrap up the interview, get your thoughts on deflation. So I interviewed Danielle DiMartino Booth last week. She said the Fed's not going to do bailouts. They're going to allow some of the regional banks to fail. They're going to allow a commercial real estate bust. She said, prepare for deflation. Do you think in a debt-based fiat currency system where debt has grown enormously, especially since 2008, but for many, many decades, do you think that the Fed and the governments and central banks can actually allow deflation for a long period of time?
See, well, first of all, she's wrong about the bailouts because we've already seen bailouts, right? I mean, guaranteeing depositors, uninsured depositors, guaranteeing their money is essentially a backdoor bailout of the asset side of these banks. You see what I'm saying?
Oh, I agree. I agree.
Yeah,
They
I
were
mean,
they were issuing press releases talking about raising the FDIC limit to 500,000, 750,000, unlimited. It was just nuts.
And that's just another. I mean, it's it's not necessarily the Fed behind the FDIC, but it's a put to the government, put to the FDIC, and then ultimately it's backed by the Fed because the Fed has to print money to monetize that.
I would say the FDIC.
Here's my thing with deflation, inflation. If she's referring to worried about deflation, meaning we're going to have prices are going to go down, right? Consumer prices are going to decline or contract. Well, who gives a rat's ass? Why is it better for me to pay more for a box of cereal today than I paid for the same box of cereal a week ago, right? Wouldn't it be better for a consumption-based capitalist economy if every time I went to the store, I was paying less for the same products? Because then I might buy more of them, right?
I agree. Yeah, deflation is beneficial for consumers. Yeah.
Then if you want to say, okay, the economic definition of inflation, which would be a contraction in the money supply, well, we're seeing that already. And that's part of the reason why all of a sudden we're starting to see these banking system blowups. So yeah, we're already in monetary deflation, and I think there's an argument to be made that's not necessarily going to because when you print money, the evidence that the money supply has increased in excess of the amount of wealth that was generated by that money being printed is price inflation, right? You got more money chasing the same amount of goods and services, or maybe even less goods and services. So if I'm not sure that a contraction in the money supply is going to lead to price deflation, because most of the inflation that we've seen since 2008 went into financial assets. So when I hear someone say they're worried about deflation, well, yeah, you're worried about a stock market crash, a bond market crash, a commercial real estate crash, et cetera.
Yeah, I wouldn't call bankruptcies.
That's what got inflated from most of this money printing that's been done since 2008.
I'm not sure I'd call bankruptcies deflation. So I think we will see some bankruptcies, whether the Fed allows them or not, for real estate investment trusts. The pension funds.
Right, but if you're a public company and you go bankrupt, that means your stock went to zero. So that's price deflation of your stock, your stock price.
Yeah, it's not general deflation though. What I think the policy decisions though from governments and central banks, they won't allow deflation for a long period of time, especially post 2008, because then their tax revenues collapse. So every time the federal government tax receipts have collapsed, so municipal bonds, others, the Fed has had to step in 2008, 2009, and in 2020, because tax receipts collapsed, and the Fed had to come in and buy U.S. treasuries, buy municipal bonds. And then you have like the Fed governors and Jerome Powell that were front running all these QE purchases because they knew the Fed was going to have to subsidize government spending because the governments don't want to cut back. They don't want to cut their budgets drastically.
Right, but then what you're talking about is economic inflation. They massively increase the supply of money, and the difference between what happened with prices between 2008 and 2020 was that most of the cash that was printed went into financial assets or houses, and then after 2020, when they printed another 4 trillion. A lot of that cash went into the real economy, right? Because you had the stimulus payments that put money in people's hands. Yep. They spent that money. A lot of people who have made a lot of money in the stock market took that money and bought cars, houses, vacations, etc. I mean, so that's where the money printing gets transmitted into the real economy, and that's where your big acceleration in price inflation came from.
Yeah, it's just creating distortions. And now with the crypto prices falling in the stock market, with the volatility of those people that made a lot of money day trading these things, they're not able to make the amount of trading profits that they are. And a lot of these people have given up and gone back to their day jobs if they can find a day job. But as we wrap up here, Dave, one last question. So at the current gold prices, we're a little under 2,000 today when we're recording this interview, probably because the market thinks that there's so much risk and the Fed's going to hike rates again. And that's going to strengthen the dollar. So gold prices got smashed. The plunge protection team or the exchange stabilization fund came in and smashed it. Oh, well, unfortunately, this happens way too often. But do you think that the juniors are going to be able to raise capital in this environment to do drilling and build mines, even with gold prices around 2,000? Or is this a very difficult environment for a lot of juniors to raise capital?
Actually, I don't know of any junior that has a valid project that hasn't been able to raise capital. Most every company that I follow and recommend in my mining stock journal, well, every company who's gone to market to raise capital has been able to raise it. And a lot of times, whereas a few years ago they had to put a full warrant on the unit, now they're doing it with a half warrant, or in some cases, no warrants. So there's a lot of capital out there right now sloshing around that is looking for valid sources of investment in the mining stock and in the junior project development segment of mining stocks. Heliostar just raised, I think it was 15 million in equity capital to pay for an acquisition and help advance the acquisition. I mean, when I first saw the amount that they were trying to raise, I'm like, whoa, that's probably going to be a chore to raise. And when I exchanged emails with the CEO, he said, we basically have commitments for most of it. And that was right after they announced it. So, I especially with the price of gold going higher. And by the way, June gold is at 2006 right now. You're right. It did get hit briefly below 2000, but it bounced back. But especially with the general uptrend in the precious metal sector that really started in September of 2022, I think unless the company is just a total dog, I don't think these companies are going to have too much trouble raising capital right now.
So you're talking about 5, 10, 15 million for drilling, not going and building a mine for hundreds of millions, because I think that the market is a lot more selective about raising hundreds of millions of dollars to build a mine, especially with higher interest rates, because the cost of capital for some of these miners, especially if it's a one project mining company where they have to bet the whole company on building one mine.
Well, if you have a feasibility study that's realistic in terms of the cost of building the mine, and you have all your permits in place, there's entities, there's pools of capital that will lend you the project financing. There's a bunch of them. There's also some banks that do it. So I think once you get to the point where you can justify a construction decision, and you've reflected your feasibility study reflects the current cost of building the mine, plus builds in a cushion for further price increases in the cost of the mine, you're going to be able to raise project financing for it, because and there's a decent chunk of equity that comes in below the project financing when you do that. So if a company, I think any company that has a fully permitted project with a bona fide valid feasibility study can raise capital to build a mine.
Oh, Cisco mining in Quebec. I know Quebec's like probably the most pro mining in all of Canada. So they just raised, I think, over 100 million because they already have a bankable feasibility study. So that project's moving forward, but that's a high grade project, high grade gold mine with some silver byproduct. They could probably sell a silver stream on that too if they need to.
I hope they don't.
Well, right? If I'm a royalty and streaming company investor and they sell it, yeah, it's good for the company that buys the stream.
Exactly. I hate streams and I hate royalties because it comes right off the top, man. It takes away from your gross margin.
Well, if gold and silver prices keep going up, I mean, the governments are going to want to increase the royalty. Look what Chile tried to do when copper hit $5 a pound last year. They tried to increase the copper royalty, and now the copper production in Chile is collapsing.
Well, that's just going to cause copper prices to go higher, right? I mean, if they do anything that curtails the amount of gold and silver production, it's going to drive the price higher.
Well, and silver is a byproduct. So if copper supply is coming offline, then that probably means less silver supply too.
That's right.
Okay, well, Dave, I've kept you past the time limit today. I really enjoyed our discussion about derivatives. I think our listeners will get a lot out of it. Unfortunately, this is the inherent problems in the system that we have, that post 2008, every couple of years now, there's going to be there's going to be derivatives problems, and the people in power, if you're watching CNBC or you're watching a speech from Jerome Powell or Janet Yellen, they're not going to be honest and tell you the truth about the derivatives market, because basically they have to bail it out every couple of years until we get rid of the size of the derivatives. It's just too big right now.
Yeah, I agree.
So if my listeners want to follow you on Twitter or check out your newsletters, how do they do so?
Twitter, just search under Dave Kranzler. I go by my real name on Twitter, and then I have my website is investmentresearchdynamics.com, and I've got links there that describe my newsletters and what's involved with subscribing to them.
And Dave grills the CEOs of these junior mining companies. So he's not taking any warrants. He's not taking any kickbacks from some of these junior mine company CEOs. He's asking them very difficult questions, and he's had successes over the years, including, I think he was in Silvercrest Metals at way under $1.
16 cents in January of 2016.